Financial experts universally demand you save 3 to 6 months of living expenses. But doing exactly what you are told and hoarding that much cash creates a massive, invisible financial liability. When you accumulate that safety net, you have 3 distinct paths for allocating the capital: checking, the stock market, or a high-yield savings account. If you leave the money in a standard checking account, inflation actively eats your purchasing power. But if you invest it in the market, a crash could wipe out your funds the exact day your roof caves in. Your emergency fund is strictly an insurance policy. Its job is not to build wealth. To evaluate the ultimate home for your cash, we have to measure it across 3 strict factors: liquidity, principal safety, and opportunity cost. Systemic economic shocks are historical certainties, not abstract probabilities. History is full of sudden collapses that catch the public entirely off guard. Choosing the wrong home for this capital creates a structural vulnerability. The safety net can fail at the exact moment the economy is most volatile. Let's look at the default choice for the cash-heavy conservative, leaving $10,000 or more sitting in a standard bank checking account. The undeniable benefit here is absolute, instantaneous liquidity. If your car breaks down at 2 in the morning, you can swipe a debit card or hit an ATM and solve the problem immediately. But this approach has a fatal flaw. You guarantee a mathematical loss of purchasing power over time. The average checking account pays an APY of just 0.07%. APY, or annual percentage yield, is a metric representing the real rate of return earned on a deposit over a year, factoring in compounding interest. At 0.07%, a $10,000 balance earns roughly $7 a year. Meanwhile, inflation actively shrinks the real-world value of that cash safety net every single year it sits stagnant. Paying for instant access with inflation decay is an invisible tax. It makes you poorer every day you do not have an emergency. Then there is the overconfident optimizer. This person puts their emergency fund in the stock market to capture an 8 to 10% historical return. The upside is growth and a powerful defense against inflation. The first trade-off is liquidity. Selling stocks, settling the cash, and transferring it to your bank requires 3 to 5 business days. That timeline is useless for a weekend emergency. This chart shows the historical unemployment rate. Personal emergencies, like losing your job, heavily correlate with macroeconomic recessions. You could be laid off during a downturn and forced to liquidate your assets at a 30% loss just to pay rent. The final trade-off is tax friction. Liquidating investments triggers capital gains taxes, adding a financial penalty to an already stressful situation. Using a brokerage account for emergencies is picking up pennies in front of a steamroller. The math does not support risking your principal when you are most likely to need it. Why do savvy people miscalculate their safety net needs? To answer that, we can look at the 2016 Survey of Consumer Finances, a comprehensive dataset analyzing household wealth in the United States. Researchers examined the conflict between objective financial knowledge, what people actually know, and subjective confidence, what they think they know. This scatterplot maps objective financial knowledge against subjective confidence. The study revealed a stark pattern. Individuals who overrate their own financial knowledge systematically underestimate the emergency funds they actually require. Overconfident people perceive a required safety net 21.4% lower than reality. This blind spot leaves people vulnerable to prolonged, multivariable emergencies. We are not talking about a quick fix like a car repair. We are talking about severe shocks like the COVID-19 pandemic or a recession where the average duration of unemployment lasts 40 weeks. Your subjective belief that you can handle a crisis using credit cards or investments is a cognitive bias. It leaves you underfunded for true economic shocks. The optimal mathematical compromise is moving your capital to a high-yield savings account, or HYSA, at an online bank. An HYSA is a deposit account that pays an interest rate significantly higher than the national average. The primary benefit is safety. Your principal is 100% protected from market crashes through FDIC insurance, eliminating systemic risk. The secondary benefit is yield. These accounts currently pay around 4% APY, which generates hundreds of dollars a year and helps mitigate inflation. You do have to accept a trade-off, sacrificing the instantaneous access of a local checking account. Because these accounts are operated by online banks, transferring cash from your HYSA to your main checking account typically takes 1 to 3 business days to settle. The high-yield savings account is the only financial vehicle that balances principal safety, yield, and liquidity. It is the efficient location for an emergency insurance policy. This chart maps options by liquidity and growth. For conservatives, paying for instant access with inflation decay is an unnecessary premium. For optimizers, relying on stocks exposes you to sequence of returns risk, the danger that market downturns occur exactly when withdrawing funds, permanently depleting capital. This allocation strategy begins with a specific split. Keep exactly 1 month of living expenses in a standard checking account for zero-friction access. Step 2. Park the remaining 3 to 6 months of required living expenses in an automated, FDIC-insured high-yield savings account. To solve the minor settlement delay of the online bank, you use the 48-hour bridge strategy. If an immediate surprise expense hits, you use a credit card to float the cost for 2 days. During that 48-hour window, you initiate the transfer. The cash from your HYSA will settle into your checking account, allowing you to pay off the credit card balance in full before incurring a single cent of interest. Separating your wealth-building strategy from disaster prevention is the way to ensure an economic shock remains a temporary inconvenience rather than permanent ruin.